Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Zhong and welcome to Through a Noise podcast. Just 3 weeks ago, we were discussing if the sell-off triggered by the inflation and the Middle East conflict would continue. We shared that as long as the fundamental stays healthy, we see equity markets draw down as buying opportunities rather than a source of concern. This week, S&P 500 is just less than 1% away from the intraday all-time high. The natural question to ask is, if this risk asset rebound would sustain? To answer that, I have with me Manpreet Gill, our Chief Investment Officer for Africa, Middle East, and Europe. Hi Manpreet. I'm sure our listeners are eager to know the answer to the question in the intro. Is the rebound in risky asset expected to sustain?
Hi, Jong. Thanks for having me on. Yes, we do expect it to sustain, and there are three, reasons that cause us to have that view. One is, of course, signs of cooling inflation, or at least expectations. Second is that strong corporate earnings beats that we've just experienced, and third is a softer than expected U.S. job market that, in our view, of course, can help support expectations of Fed rate cuts. Now, on the first point, next week's US CPI inflation number is, of course, quite important because if the data shows consensus estimates, it basically confirms consensus estimates rather that inflation has started to cool after the first quarter rebound, we do see scope for this year's outperformance in stocks over bonds and cash to extend and possibly US stocks to break above their March all-time high. I think it's interesting that the third failed attempt we witnessed by the policy-sensitive 2-year US government bond yield to decisively rise above 5% could be quite a significant signal because it suggests markets agree with the Fed view that the next policy change, whenever that happens, is likely a rate cut rather than a rate hike. That's, of course, because bond yields typically peak around the peak in Fed policy rates. On the third point, while the Fed is, of course, keenly watching inflation, we believe it's likely to be equally sensitive to slowdown in the job market. For now, a sustained pace of monthly job creation of around 175,000 jobs should keep the unemployment rate stable. However, any further rise in the jobless claims could push up the jobless rates above the Fed's 4% long-term target, which in turn would trigger several time-tested indicators of a recession. Hence, we believe the Fed will start to cut rates in Q3 to support growth. Now, that's, of course, on the possibility of the US equity rally sustaining. In China, of course, we also see the room for the rally to sustain, but for the short term and for slightly different reasons. I think first is we believe Chinese equities, of course, have benefited and continue to benefit from a rotation of funds from the US market. It's also been supported by now coming up on almost a month of consecutive positive inflows from southbound trading, which is basically mainland Chinese investors adding to Hong Kong equities. And positioning overall still remains light for the MSCI China index, and valuations, of course, continue to be well below the long-term average. But in the longer term, and especially in the coming week, the first quarter earnings from widely held Chinese internet companies will be an important focus because we believe there will be a short-term tactical opportunity in Chinese equities once the Hang Seng Index corrects to the 17,800 level. But for a longer-term sustainable uptrend in Chinese equities, we'd really need to see the earnings revision start to stabilize or turn positive.
Do you see value in Chinese US dollar bonds amidst the recent rebound in Chinese equities?
Well, it's a natural question to ask, but I think it's much more challenging to make the case that positive sentiment in equities spills over to Asia dollar bonds. Now, in contrast to China dollar bonds, valuations suggest Chinese equities have been undervalued for some time, but in bonds, yield premium is currently quite expensive relative to own history. Additionally, the yield premium is at the tight end of historical range, even relative to developed market peers. So that does limit the room for meaningful spread compression. That said, we do see some value in China dollar bonds, mainly for two reasons. First is that despite the tight yield premium, nominal yields continue to look quite attractive due to the elevated government bond yield. Second, of course, we believe that relative value opportunities within high yield still exist. So in our view, fundamentals in sectors like industrials and financials are still pretty strong, despite a still challenging outlook for the property sector. So Given this balanced risk reward profile, we do believe a neutral or what we see as a core holding to Asia dollar bonds is warranted, with a preference, of course, for high yield over investment grade.
You shared about US equities and Chinese equities. How about the UK equities? What is the outlook there?
Well, I think a good question. I mean, we don't always focus on markets like the UK, but the strong performance of UK equities in recent weeks certainly has been interesting, and we can attribute it largely to a rally in the healthcare sector. But overall, our view on UK equities remains a neutral, or that of a core holding, and we expect the region to perform in line with global equities over the next 12 months. So that's a reasonably constructive view. Now, valuations remain appealing, with the MSCI UK index trading at a 12-month 4P of about 12 times. That's still below its historical average, despite a modest re-rating this year. I think UK equities' defensive nature and the market's value bias can also help the market weather any unexpected economic downturn and a higher for longer yield environment. That said, we do remain cautious over the UK's subdued EPS growth expectations of only about 2% for 24. That's, of course, well below consensus of global equities and our other major developed markets, including the US. Now, looking ahead, we do see opportunities to stay invested in the UK via what we see as a bit of a barbell strategy. So, overweight the energy sector on one hand, and the healthcare sectors. We're also bullish on energy prices given subdued supply and geopolitical tensions and strong demand. The healthcare sector, of course, providing secular growth exposure with expected EPS growth of about 7%.
Lastly, I think what is the view on industrial metals and I think correspondingly the material stocks as well?
Well, industrial metals have been strong in recent weeks. Specifically, copper reached a 2-year high and with over 14% gains last month. Now, there are a few factors that powered this move. We've seen global manufacturing activity begin to stabilize, as evidenced by improving manufacturing PMI globally, or at least in some major economies. Second, of course, China is a major source of demand, and most industrial metals and a share of global copper consumption, for example, was 60% in 23. And the firming of growth momentum in China did boost industrial metals. And finally, inventories remain tight for some industrial metals due to supply disruptions from mine closures. Now, the use of copper electrification trends does argue for a positive structural outlook. However, a technical indicator is now pointing to overbought conditions, which does imply limited gains in the near term. Now, remodeling industrial metal prices did lead us to upgrade our view on the material sector from what was an underway to a more neutral view in our glass global market outlook. The announcement of a large hostile takeover in the mining sector also highlights the strategic importance of copper. However, we do expect global growth to slow in second half, softening demand for commodities. So we expect material stock to perform in line with the broader market over the next 6 to 12 months. So a reasonably constructive view.
As always, you have given us very valuable insights, Manpreet. Thanks for that. To just sum it all up, next week US consumer inflation data, that's key to the durability of this equity market rebound. If the data confirms consensus estimates that inflation have started to cool after the Q1 rebound, we see scope for this year outperformance in equities over bonds and cash to extend, and for US stocks to break above its all-time high hit back in March. That's all the time we have for today. Thank you for your kind attention. We'll speak again next week. Have a good weekend ahead. Cheers.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.